Let's skip the slow build today. 25 housing markets are already in measurable breakdown, not declining, not softening, not correcting. Breaking down, the difference matters. Softening is prices growing more slowly. Correcting is prices retreating from a peak. Breaking down is inventory surging, price reductions accelerating, days on market doubling, foreclosures climbing, landlords cutting rent, builders offering cash to move finished product, and the natural buyer of each market sitting on the sideline doing math that doesn't work at current prices or current rates. That last phase is where all 25 cities on this list currently live. Some of them are early in it, some of them are deep in it, all of them are in it. We are going to cover every single one, fast, specific, and with the data that explains exactly why each city is on this list, rather than the one next to it that looks identical on the surface. We've organized the 25 into 3 tiers. Tier 3, cities in early breakdown with clear warning signals already in the data. Tier 2, markets where the correction is active and deepening. Tier 1, the cities where the breakdown is most severe, most structurally embedded, and least likely to resolve quickly. We'll move through the tiers in order, and we'll finish with the one national pattern that connects all 25 of them. No fluff. Subscribe, and let's go. Tier 3, early breakdown, the signals are in the data. These 8 cities are not yet in visible crisis. Surface conditions still look tolerable. But the leading indicators, inventory, days on market, price reductions, delinquency trends are already flashing the same pattern that preceded every correction on this list. 25. Charlotte, North Carolina inventory up 38%. Price reductions on 22% of listings. Days on market up 40%. The financial sector employment anchor, Bank of America, Wells Fargo, Truist, is showing its first signs of hiring deceleration. Charlotte built 9,000 new apartment units in 2024. Urban core vacancy above 10%. The city is running 2 speeds simultaneously, South End and Uptown struggling, outer suburbs holding. When a market this size splits that cleanly between product types, it is not stability, it is the early geometry of a correction. 24. Raleigh, North Carolina, active inventory up 44%. Median days on market more than doubled. A developer with 340 units delivering in Q2 reports 34% pre-lease, against a historical norm of 71%. Another 5,000 units in the pipeline. The Research Triangle's tech employment base is subject to the same sector-wide headwinds hitting every knowledge economy city on this list. Remote work normalization is pulling workers who came for the Bay Area arbitrage back to the Bay Area, or further out to markets even cheaper than Raleigh. The 44% inventory jump is the first chapter of a longer story. 23. Indianapolis, Indiana inventory up 31%. Price reductions on 19% of listings, nearly double the rate from 2 years ago. Mortgage delinquency rate up 0.6 percentage points in 12 months, one of the larger increases among mid-sized metros not yet classified as distressed. Foreclosure filings up 18% year over year. Indianapolis spent years being the Midwest market that was immune to speculative excess. It is now showing every leading indicator of a market that absorbed migration-era pricing without the migration-era income growth to sustain it. The immunity was never structural, it was temporal. 22. Richmond, Virginia inventory up 29%. Price reductions on 21% of listings, nearly triple the rate from 2 years ago. A mortgage broker in the market reports purchase application volume down 28% year over year, not from financing constraints, but from buyer confidence collapse. Qualified buyers sitting voluntarily on the sideline is one of the most significant demand signals a housing market produces. Richmond's federal adjacent employment base, contractors, consultants, logistics firms serving the government, is more sensitive to federal spending contraction than the state government employment numbers suggest. The buyers know something the headline prices haven't priced in yet. 21. Huntsville, Alabama inventory up 46%. Days on market tripled from 2022 peak. Over 4,200 new residential units delivered in 2024 into a metro of 500,000 people, one of the highest new supply-to-population ratios in the country for a market this size. A local developer describes absorption 70% below what they modeled. The supply overhang is concentrated in specific corridors: Research Park, Bridge Street, Madison County edges, creating localized vacancy pockets significantly worse than the metro average. Huntsville was discovered overbuilt and is now working through the consequences of being the city everyone recommended at the same time. 20. Memphis, Tennessee institutional investors control 8 to 12% of single-family rental stock in some Memphis zip codes. Those investors are beginning to exit. 3 portfolio owners representing 60-plus units signaled exit intent to a local property manager in a 60-day window. When institutional capital exits a market, it entered at scale. It does not exit gradually. Portfolio decisions dump inventory simultaneously. Single-family listings up 34% year over year. The local buyer pool, working-class households who are the natural buyers for Memphis homes, has been squeezed by the same inflation and rate environment affecting renters everywhere. The conditions for a supply shock are assembling. The shock has not arrived yet. 19. Columbia, South Carolina. Columbia doesn't make the housing market headlines. That is precisely the problem. Inventory up 33% year over year. Price reductions on 20% of active listings. New construction deliveries in 2024 were 40% above the 5-year average. Columbia's economy, state government, University of South Carolina, military installations is stable but not growing fast enough to absorb what got built. The city was caught in the Sunbelt's gravitational pull during the boom. Developers who couldn't get land in Charlotte or Nashville found Columbia's land prices attractive and built accordingly. The demand that justified those builds in the developer's spreadsheet was regional optimism, not Columbia-specific analysis. The market is correcting for that difference now. 18. Tucson, Arizona. Tucson has always been Phoenix's more affordable, quieter neighbor. It is now Phoenix's more affordable, quieter neighbor with a 35% inventory increase, price reductions on 23% of listings, and a new construction pipeline that added 3,800 units in 2024 into a market where the absorption rate has not kept pace. Tucson's university economy, University of Arizona, provides a stable renter base but not a buyer base for the ownership tier product that got built. Insurance costs are rising in tandem with the Phoenix market. The heat exposure is equivalent. The economic depth to absorb supply shocks is not. Tier 2. Active correction. The breakdown is measurable now. These 10 cities are past the warning signal phase. The correction is active, it is in the headline numbers, and it is deepening. Prices are falling. Vacancy is climbing. The investors who bought at peak are doing math that doesn't work. The question in these markets is not whether the correction is real. It is how deep it goes before the supply clears. 17. Jacksonville, Florida, active listings up 47% year over year. Price reductions on 28% of listings. Days on market doubled. Jacksonville avoided the worst of the Florida mania. No crypto investor wave, no bachelorette economy, no international capital surge. It appreciated at a measured pace that looked responsible by comparison. That responsible appreciation is now correcting with the same inventory surge and buyer retreat as the markets that overheated more dramatically. Insurance costs are the hidden driver. Average homeowner premiums now exceeding $5,000 annually in many Jacksonville zip codes. A homeowner who bought in 2020 at 1-800 annual insurance is now paying $4,900. The mortgage is fixed. The insurance is not. 16. Salt Lake City, Utah. Price to income ratio of 7.2, among the most stretched in the country for a non-coastal market. Active inventory up 52% year over year. Price reductions on 27% of listings. Days on market nearly tripled from 2022 low. The Silicon Slopes tech base is subject to the same sector contraction affecting every knowledge economy city on this list. More critically, Salt Lake's natural buyer, the young family-forming demographic that is the city's demographic advantage, has been priced so far out of the market that first-time buyers earning $85,000 are looking at a median price of $590,000 and doing math that resolves in one direction. When you price out your own replacement buyer, the demand floor disappears. 15. Nashville, Tennessee, 8,000 new apartment units delivered in 2024, a metro record. Rent down 10 to 13% from peak. Active listings up 35%. Days on market up 42%. The short-term rental reversal adds a supply dimension the new construction numbers alone don't capture. Thousands of Airbnb units returning to the long-term rental market simultaneously as tourism normalizes and the city tightens STR regulations. Nashville's overbuilding error is product type. The city built luxury at scale while accumulating a genuine shortage of workforce housing. The units that are empty are priced for a demographic that has options. The workers who need housing can't afford the options. 14. Northport to Sarasota, Florida, active listings up 48%. Days on market doubled. Price reductions on 29% of listings. Domestic migration inflow down more than 60% from peak. Sarasota's wealthy buyer base, supposed to be its buffer against correction, is actually its vulnerability. Wealthy buyers can wait indefinitely. They have no urgency, no financing pressure, no deadline when they collectively step back and wait to see how far prices fall. The market stalls in standoff. Sellers at 2022 prices, buyers with 2026 calculators, agents showing properties that aren't going to close. The standoff ends when sellers run out of time. With 48% more listings than a year ago, some of them are running out. 13. Columbus, Ohio listings up 41%. Price reductions on 24%. One of the higher rates among mid-size markets. Days on market up 44%. The headline number, 5,500 new apartment units delivered in 2024. The largest single-year addition in metro history. The hidden number, the Intel semiconductor factory that was the cornerstone of Columbus's growth narrative, has experienced significant delays. Jobs expected in 2025 are now projected for 2027 or later. Developers built for a version of Columbus that is 18 to 24 months away. The units are there, the demand isn't. In real estate, 24 months of gap between supply and demand is not a footnote. It is the correction. 12. San Antonio, Texas. 18,000 new housing units added in 2023 and 2024 combined. Active listings up 43%. Days on market doubled. A major builder's sales manager reports 340 completed homes sitting in finished inventory, moving 18 units per month, 19 months of supply. Another 9,000 units scheduled for delivery in the next 18 months from projects already under construction. San Antonio's unlimited land availability on its northern edge, which was an asset when demand was strong, becomes a liability when demand softens because there is no geographic break on supply. The pipeline keeps delivering long after the market has signaled it should stop. The break is financial, and it takes time to engage. 11. Charlotte Urban Core. While Charlotte Metro reads as Tier 3 on aggregate numbers, the Urban Core, South End, Noda, Plaza Midwood, deserves its own Tier 2 entry. Apartment vacancy in Uptown and South End above 10% for the first time since 2015. Rent down roughly 7% year over year in these submarkets. Buildings that ran 12-month wait lists in 2022 are now advertising move-in specials and flexible lease terms. The suburban Charlotte market is performing near 96% occupancy with no concessions. The same metro, two completely different realities. The overbuilding happened in the urban core. The correction is happening there too. The suburbs are, for now, fine. 10. Boise, Idaho rents down 13% year over year. Steepest decline in the Mountain West. Vacancy rising faster here than almost anywhere outside the major Sunbelt metros. The Californians and Seattleites who drove the boom have quietly packed up and left as remote work policies tightened and offices reopened. What remains is the original Boise renter base. Nurses, teachers, state employees who were priced out during the boom and have not rushed back. A local resident who was priced out in 2021 from $900 to $1,600 rent, then moved to Nampa, is watching her old apartment listed at $1,200 with a month free. She says she'll wait until it hits $950. She's right to wait. She has the leverage now. 9. Seattle, Washington. Rents down roughly 10% year over year. Vacancy climbing in South Lake Union, Capitol Hill, and Belltown, the neighborhoods most dependent on tech worker demand. Buildings running no vacancy signs are advertising cash incentives and waived deposits. Several large development projects paused or abandoned. The anchor of the market, high-income Amazon and Microsoft workers in specific zip codes, is the exact demographic most affected by remote work normalization and the tech sector's broader contraction. Seattle built concentrated supply in the neighborhoods closest to the campuses. Those neighborhoods are now experiencing the most acute vacancy because the demand that defined them has dispersed. Tier 1. Severe breakdown, structural deep, slow to resolve. These 7 cities are not in early warning. They are not in active correction. They are in breakdown that is structural, like driven by insurance crises, foreclosure surges, overbuilding at a scale that will take years to absorb, or demand reversals that are not temporary cycle events, but permanent repricing of what these markets are worth at what they cost. These are the markets where the silence in the sales offices is loudest. 8. Houston, Texas. Houston's breakdown is quieter than Austin's, but wider. Active listings up 39% year over year across the metro. Foreclosure filings up 22%, one of the largest absolute increases in the country given Houston's market size. Insurance premiums have climbed 40 to 60% in 3 years, driven by climate risk repricing after Harvey and subsequent flood events. A homeowner carrying a $3,200 mortgage is now absorbing $900 a month in insurance costs that were $400 3 years ago. The monthly payment math has changed without the mortgage changing. New construction continues from the approval pipeline. Houston's geographic sprawl, no zoning, unlimited land, means supply always responds aggressively to demand signals. The demand signal changed. The supply did not stop in time. 7. Denver, Colorado. The most alarming number on this entire list. Colorado recorded a 145% year-over-year increase in foreclosures. The largest surge of any state in the country. Not the largest in the Mountain West. In the country, foreclosures more than doubled in a market long viewed as resilient. Inventory above pre-pandemic 2019 highs, meaning Denver has more homes for sale than it did before the boom, at prices still significantly higher than then. The state budget swung from surplus to a projected $750 million shortfall. Active listings up 39%, price reductions on 26%, the tech-adjacent employment base softening. A 145% foreclosure increase in an economy technically still growing means the carrying costs at peak prices are structurally unsustainable for a significant portion of buyers who stretch to get in. That resolves through price correction, not patience. 6. Cape Coral, Florida. Active listings up 51%, the largest inventory increase of any major Florida market. Days on market nearly tripled, price reductions on 31% of listings. Average homeowner insurance now exceeding $8,000 annually in many zip codes. Several insurers have stopped writing new policies in Southwest Florida entirely. A short-term rental investor who bought 3 properties in 2021 and 2022 reports combined insurance costs climbing from $4,200 to over $19,000 in 3 years. He is selling 2 of the 3 at a loss because the carrying costs exceed the losses on sale. That is the calculation driving the 51% inventory surge. The correction is not coming. In many cases, it is already in the insurance bill. 5. Tampa, Florida. Active listings up 41%. Days on market doubled. Price reductions on 27% of listings. But the number that defines Tampa in 2026 is not in the rental or for sale market. It is in the condo special assessment data. Post-Surfside building inspection requirements are producing repair mandates being passed to unit owners, as special assessments in some cases exceeding $50,000 to $150,000 per unit. A Tampa owner received an $87,000 assessment on a unit worth $340,000 she paid $285,000 for. She is forced to sell. Her net proceeds after the discount buyers apply for the outstanding assessment, approximately $190,000. She did nothing wrong. She maintained her unit. She paid her fees. The bill arrived from a building she could not control. That manufactured forced selling is adding a supply dimension to Tampa's market that new construction numbers alone cannot capture. 4. Phoenix, Arizona, 30,000 new apartment units in a single year. Active inventory 53% above the 5-year average. Apartment vacancy above 11% in several Class A submarkets. Rent down 12 to 15% from peak, depending on submarket. Builders offering $50,000 incentive packages on completed single-family homes. The for-sale market has buyers considering a variable that no housing pro forma from 2021 adequately priced. Phoenix recorded more than 100 days above 110 degrees in 2024. Utility bills of $400 to $600 per summer month. Outdoor usability limited to 5 months of the year. The migration wave that built this market was driven partly by lifestyle optimization. The lifestyle is being recalculated by the people who made that optimization and are now living the reality of it in August. Some of them are the migration reversal the data is measuring. 3. Austin, Texas rent down 14% year over year. Home prices down 10 to 12% from peak. Apartment vacancy above 12% in urban core submarkets. More than 12,000 new units delivered in 2024. A developer reports 240 units delivered in Q4 with a lease-up pace of 22 units per month. 11 months to stabilization on a loan that matures in 8 months. That 3-number gap is the most honest description of Austin's breakdown. The buildings exist, the financing is real, and the math between them doesn't work at current absorption rates. The tech workers who were the anchor demand, the high-income relocators whose salaries justified the rents that justified the development, are gone through layoffs at Tesla, Oracle, and Meta's Austin operations, or through the normalization of remote work that let them choose cheaper markets. Austin built Silicon Hills. Silicon Hills had layoffs. The vacancy is the invoice. 2. Miami. Florida rent down 11% year over year. Vacancy climbing in Brickell, downtown, and Miami Beach. Luxury buildings with ocean views offering gift cards and zero move-in fees. But the defining Miami number is the carry math. An investor who bought a Brickell unit in 2021 for $620,000 now faces $5,400 monthly carrying costs. Mortgage, HOA, insurance, property taxes. The unit rented after 2 months empty at $3,800. He is losing $600 per month on a rented unit in the most desirable city on this list. HOA fees are jumping as buildings comply with post-Surfside structural requirement. Insurance has tripled in many cases. The investor bought at peak pricing, got hit by insurance reset, HOA increase, property tax assessment increase, and rent correction simultaneously from 4 directions at once. There is no single fix for a margin compression from 4 directions. There is only time and price. 1. San Francisco, California. Number 1 is not a Sunbelt story. It is the warning that precedes every Sunbelt city on this list by a decade. San Francisco's rent is down 15% year over year, the steepest decline of any major metro in the country. Vacancy in the downtown core is breaking records. High-end towers that commanded $4,000 a month are offering the same units at $3,000 with 6 weeks free. More than 50,000 residents have left the city since 2021. The 4 lease signs in the downtown corridors look like they have been there long enough to become part of the architecture. San Francisco's breakdown is not primarily a housing market story, it is an identity story. The city that defined itself as the center of the innovation universe stopped being compelling to the people who paid to live at the center. When the story of a place changes at that fundamental level, when the density of daily life, the cultural energy, the proximity to ambition that justified the price no longer exist at the scale that justified it, the rent follows. And the rent has followed sharply and without a clear bottom yet. San Francisco is not the end of this list because it is the worst housing market in America. It is number 1 because it is the most complete version of the story that every other city on this list is in an earlier chapter of. A market that was priced for a future that overshot, built for a demand level that was real at its peak and is normalizing now, and is correcting at a pace that reveals just how much of its valuation was story and how much was structural. Every city on this list is San Francisco in an earlier chapter. That is not meant as a prediction of identical outcomes. The fundamentals vary enormously. It is meant as a reading guide. The chapter numbers are different. The story is the same. 25 cities, 3 tiers. One pattern. Every market on this list followed a version of the same sequence. Demand arrived. Genuine, real, data-supported demand driven by migration, remote work, low rates, and a once-in-a-generation reshuffling of where Americans chose to live. Developers and investors read that demand and responded with supply. The supply arrived on a 24 to 36 month construction lag. By the time it delivered, the demand that justified it had normalized. The supply was real. The demand forecast was a one-time event that got modeled as a baseline. The correction is the market resolving the difference between those two things. The cities that are deepest in breakdown, San Francisco, Austin, Miami, Phoenix, are the ones where the supply response was most aggressive and the demand normalization was most severe. The cities in early breakdown, Charlotte, Raleigh, Indianapolis, are the ones where the same sequence is underway but earlier in the timeline. The tier placement is temporal, not structural. Given enough time and enough supply, every city in tier 3 becomes tier 2. The question is whether the demand catches up before the correction deepens. The national data is not ambiguous on where 2026 sits in that timeline. New apartment supply in 2024 hit the highest level since 1986, nearly 440,000 units delivered nationally in a single year. Rent growth has gone negative in more than 30 major metros. Concessions have returned to markets that hadn't offered them since 2019. Foreclosure activity is up in more than 40 states. The mortgage delinquency rate is ticking upward from a low base in markets where the rate moved from 3% to 7%, added $1,000 or more per month to carrying costs on homes purchased at peak prices. None of this is 2008. The loan quality is different. The financial system's exposure is different. The policy toolkit for managing the correction is more developed. But the housing market is correcting. It is doing so across a wider geographic footprint than most coverage acknowledges, and the cities on this list are the evidence. If you own in any of the Tier 1 or Tier 2 cities on this list, your carrying costs are the only number that matters right now, not the Zestimate, not what your neighbor sold for at the peak, your monthly cost to hold the asset relative to its current market value, and your timeline to sell if you needed to. If that math works over a 2 to 3 year horizon, you probably have room. If it doesn't, the market has been trying to tell you something, and the cost of not listening compounds monthly. If you are renting in any of these markets, you have leverage you may not be fully using. The concessions are real. The vacancy is real. The landlord's willingness to negotiate is higher than it has been in 3 years. Use that, not aggressively, just honestly. The math is on your side in a way it was not in 2022. If you are waiting to buy, the bottom is not uniformly in. In some of these markets, it may be close. In others, the supply pipeline alone suggests another 12 to 18 months of downward pressure before the clearing happens. Research the specific submarket, not the metro average. The two-speed dynamics we identified in Charlotte and Seattle and Nashville are present to some degree in almost every city on this list. The right zip code and the wrong zip code in the same city are currently living in different markets. Drop your city in the comments. Tell me which tier you think it belongs in and what you're seeing on the ground. The data tells one version of each of these stories. The people living them tell another. Both versions belong in this conversation. This was the full 2026 breakdown. 25 cities, one pattern. Subscribe because the next chapter of this story is already forming in the data and will be here when it does.